Are you here to improve your investment strategies? Are you looking for that one article that could help you finalize that decision you were holding off? Well then, get ready to learn more and gain just that subtle extra knowledge to get an edge in the investment business. Because if you're new here, then you've come to the right place. Welcome to the Daily Fortune, a channel where we talk about all the latest news, updates, guides, and strategies related to investment. Of course, with that said, we're going to be discussing a lot about the Oracle of Omaha, Warren Buffett, The Big Short, Michael Burry, the money tree, Cathie Woods, Tesla's very own CEO and eccentric billionaire, Elon Musk, along with the rest of the big leagues to learn just a bit more from the professionals. And don't worry, of course we talk about crypto, and we also talk about the best stocks to invest in, along with many tips and tricks on how to handle your finances so you never lose. So before we talk about making money, remember to hit that like button, subscribe, and ring that notification bell as well to make sure you won't miss a single video. Now let's get started. The ever-famous billionaire investor, Michael Burry, made billions not once, but thrice. He predicted the dot-com bubble and the 2008 recession, as well as the recent market downturn. Although the market has already plummeted dramatically, Burry believes it's only the beginning. He still believes the market will drop by more than half from its current levels. In this video, we'll talk about how Burry has already made billions and how you can do the same with your portfolio. Because he makes the majority of his money from market crashes, many investors called Michael Burry a broken clock. Market timing is pretty hard, and Burry is no exception. He's been ahead of the curve on every prediction he's made, but has also been right in the end. In a tweet, he said, "Habitually be 1 to 2 years early on literally everything, and you can attain broken clock status." Burry predicted the market crash in late 2021. Although it has been a while, the situation has unfolded exactly as he predicted. He predicted rising inflation, a crash in growth stocks, a market correction, and a bond market crash. Burry seems to get it right. The predictability of human nature is one of the main reasons why Burry has been able to foresee market crashes. While technology advances, human behavior remains constant, and history proves this. Third time's the charm. 10 years leading to a financial crisis. Yellow S&P 500 in 2000, white S&P 500 today, green Dow 1929. Gotta love human nature. Nothing if not consistent. The green line is the indication of the roaring 20s prior to the Great Depression, while the yellow line symbolizes speculation during the dot-com bubble. Both of these times saw unusual amounts of financial risk, which resulted in a dramatic decline. Unprofitable internet stocks rose 1,000 or even 2,000% during the dot-com bubble before falling to zero. There was also a lot of speculation in the roaring 20s. Within 9 years, stock prices had quadrupled, and the majority of investors believed that prices would continue to rise. Burry used a newspaper to demonstrate how absurd the speculation was. Despite the fact that the market had fallen for the day, a rally at the market close pleased brokers, according to the headline. Both of these bull runs speak to one type of behavior, and that's greed. Such greedy behavior was also seen in 2020 and 2021. Although the market may recover in the short term, Burry believes the market will crash in the next year or two. After 2000, the Nasdaq had 16 bear market rallies above 10%, averaging 22.7% before bottoming down 78%. After 1929, the Dow had 10 bear market rallies over 10%, averaging 22.8% before bottoming down 89%. Burry is basically suggesting that the market will see short-term rallies, but that this shouldn't be mistaken for long-term recovery. Dead cat bounces are the most epic. 12 of the top 20 Nasdaq one-day rallies happened during the 78% loss from 2000's top. 9 of the top 20 S&P one-day rallies happened during the 86% drop from 1929 top. He added in a tweet to further explain his prediction. During long-term market crashes, the market always rallies the greatest, which is completely misleading. Burry has identified many correlations, but we all know that correlation does not imply causation. Michael Burry has identified some worrisome fundamentals that support his prediction. You might be all aware that the macroeconomic situation is horrifying. There are economists who believe that the situation between Ukraine and Russia is on the verge of collapse. Others would claim that China's economy is weak or that US interest rates will continue to rise. All of these macro scenarios may be right, but only one factor will cause the economy to implode, and that factor is the consumers. The consumer is practically the sole driver of the economy. Personal consumption spending accounts for over 70% of the US GDP. The entire economy will collapse if the consumer feels weak at any point. The present macro problem revolves around the consumer's declining purchasing power. The economy will crumble if we all stop consuming so much and start saving. Burry stated, "This is the problem. Minus 850 billion in direct stim checks, 400 billion in cash out refis, 1 trillion plus in forgivable loans, 250 to 500 billion of which is fraudulent, another 4 trillion indirect, etc. What recapitalizes the consumer now? Higher wages can't do that. The economy is seeing massive price hikes, and individuals like you are facing a significant decrease in the value of your money. This drop in purchasing power isn't just a coincidence. A variety of statistics indicate that consumers are at their weakest point in history. The University of Michigan Consumer Sentiment Index is the most well-known consumer sentiment indicator, and the index is currently at historic lows, indicating that consumers feel weak. The slowdown in Amazon's revenue is another sign of a weaker consumer. Amazon's first quarter results were terrible, with revenue up only 7% year over year and profitability well below expectations. Amazon has become the major marketplace where most people buy their items in the modern age. Amazon's bad quarterly performance demonstrates how vulnerable consumers are. And so Amazon says to GDP, "There's your weakening customer," Burry tweeted. So how has Burry made millions given all of this information? Can investors also do it? Lower profit margins, according to Burry, will be the first economic impact of weakened customers. The effort for businesses to keep their pricing high will be at the forefront of this. Consumers are more vulnerable than ever, forcing businesses to decrease prices. The problem is that earnings do not change very often. As a result, wages will stay high in comparison to prices. Business profit margins will drop significantly because of having to decrease prices while still paying increased wages. Following a big drop in sales, equities will eventually trade at lower price-to-sales ratios. Burry is building his portfolio to profit millions, if not billions of dollars by shorting bonds in the coming year. In late 2021, he announced that he was specifically shorting 30-year treasury bonds. "For what it's worth, I've never shorted any cryptocurrency. This is my third bubble and the biggest. I've learned a thing or two. 30-year treasuries, on the other hand," he tweeted. The rate of inflation was approaching 7%, while 30-year bond yields were still hovering around 2%. In the short run, this meant bond investors were basically sure to lose 5% per year. Bond yields and prices have an inverse correlation. Bond prices dropped as bond yields rose. TBT, the ProShares Ultra Short 20-plus year Treasury ETF, is an ETF that short sells a bundle of bonds that Burry has previously purchased. Bond yields have risen dramatically in recent months due to interest rates, inflation, and the Ukraine situation. Bond prices have collapsed as a result, while TBT has risen. Since Burry first announced a short position, the TBT ETF has gained by approximately 43%. That's a lot of money, but Burry expects to make even more in the future. 1977 says hello, Burry tweeted recently, along with a photo of himself from 1977. This was in reference to the 1970s economic crisis. The great inflation of the 1970s was characterized by unprecedented levels of inflation. In 1977, inflation was 6.5%, but by 1980, it had risen to above 14%. This is a case that's remarkably similar to our situation now. Inflation is currently about 8%, but Burry believes it could soon reach 10% or even 15%. The fact could be that inflation has already surpassed 10%. Burry doubts the Consumer Price Index, CPI, which is used to calculate inflation. He described how the CPI housing costs rose 5% last 12 months. Wrong. CPI would be 12% using real-world NAR housing data. BLS has smoothed out housing numbers forever because home prices have been a problem forever. So next month, they'll start smoothing out vehicle prices. Hashtag problem solved. According to the CPI, home prices only increased by 5% in the previous year. This is absolutely false. If real-world housing statistics were used to calculate home prices, CPI inflation would be at 12%. That means the current inflation rate of 8% is 4% off the mark. This error, together with other macro factors, will force the market to drop by around 55% from current levels. Burry stated, "Paradigm shifts, speculative peaks. The S&P 500 bottomed 13% lower than 2002's bottom in 2009, 17% lower than 1998's long-term capital management crisis low in 2002, and 10% lower than the 1970s low in 1975. 15% lower than the COVID low is SPX 1862, roughly Shiller P/E of 16, nominal P to E of 9 in historic range. Michael Burry observes a pattern of market crashes becoming increasingly severe over time. If this trend holds, the S&P will crash to a level that's only slightly lower than the COVID crash. Burry uses 15% as an example to explore if this is theoretically possible. If the S&P 500 were to drop to a level of 15% lower than the previous low during COVID, the index would be around 1,800 points. This is around 55% lower than current levels and would return the index to its historical price levels. The Shiller P to E ratio is depicted in one of the graphs Burry sent with his tweet. A cyclically adjusted P to E ratio is the Shiller P to E ratio. It adjusts for inflation by adjusting the P to E ratio. The Shiller P to E ratio is at 36. This ratio would drop to around 16 in a 55% decline, which is close to the historical average. Burry also included a graph depicting the historical average for the nominal P to E ratio, which is just the price to earnings ratio over the previous 12 months. The P to E ratio is at 21 now. A 55% drop would reduce this to around 9. A P to E of 9 would be somewhat below the average, which Burry considers acceptable. All of this supports his prediction that the suffering will continue. Some of you believe that short-term market crashes have no bearing on long-term stock investments. This is entirely true if you can take the psychological pain of seeing your portfolio collapse. Short-term crashes and long-term profits are inevitable for great companies. During the dot-com bubble, Amazon was one example of this. Burry wondered, how far can the stock of a good growing company fall? One destined to be one of the greatest companies in the world. Remember when Amazon fell 95%? But the Fed didn't have inflation like this hanging over its head either. If you aren't willing to keep your trust in a stock that's dropped by more than 95%, the stock market may not be for you. Short-term volatility has an emotional impact on all investors, and managing that feeling is extremely hard. Another clue pointing to a further crash is trading volume, which is related to volatility. During market crashes, trading volume tends to be higher since buyers on both the buy and sell sides are more active. The current trading volume of outstanding shares is at an all-time low. Burry explained, top to bottom, Microsoft traded 5.2 times its shares outstanding by 2002, 3.3 times by 2009, and 0.5 times so far. Amazon traded 5.7 times by 2002, 6.6 by 2009, and 0.9 times so far. JP Morgan traded 3 times by 2002, 5.9 times by 2009, and around 0.7 times so far, etc. Enough takes time. To make the market comparable to prior crashes, trading volume must expand by 5 to 10 times from current levels. That's because when prices are low, the market has a higher trading volume. To match the trading volume of prior market crashes, the trading volume would have to rise dramatically. Remember that Michael Burry is not a financial advisor. He's just a hedge fund manager who stands to make a lot of money if the market crashes. Always do your own research before investing and invest at your own risk. What do you think about the Big Short 2 that will come anytime after Burry makes billions again? And that was today's video. Thank you for watching. So that's it for today. I hope you learned something from today's video. And to get updated with the next videos, don't forget to hit the notification bell. See you next time.